Rio Tinto have just had their earnings call, and quite honestly, there are a few big outcomes from it. So let's not waste any time and dive straight in. The first thing that I want to discuss is the earnings that they reported. Rio reported earnings of $13.3 billion in 2022 compared to $21.4 billion in 2021. And their forecast was $13.8 billion, so they missed hitting this. This means that they had a drop in profit in earnings by 38%. But remember, Rio Tinto is a mining company, it's a mining stock, and in that sector, things are pretty cyclical and pretty volatile. We expect times of higher profit and times of lower profit. We can't really expect a volatile, cyclical stock like Rio Tinto to have a really steady and stable performance. And if you hold Rio Tinto in your portfolio yourself or you follow along with this company, you'll know that in recent times they have been doing extremely well. The gains that they have been seeing have been crazy. And those gains in stock price and performance that we've been seeing recently, although they've been really nice to see from the point of an investor investing into Rio Tinto, they're just not sustainable. So this leads you to wonder, what has actually caused this decline, this cut in profit? And has this been caused by something that Rio Tinto has done and caused, or has this been something outside of their control? Well, this drop in profit has actually been caused by a variety of different factors. The main one here is the weaker iron ore prices as the demand from China slowed down. But now China has reopened, we might be able to expect this to start rebounding in the near future. You can see here that for a lot of 2022, the iron ore prices have actually been gradually falling. They seem to be on a bit of a rise again now, perhaps due to China reopening and other factors. But yeah, this definitely came into play as to why Rio Tinto was hit so hard in terms of earnings. On top of this, there's been higher labour and material costs, which have also fed into this. Next up, we have revenue. They reported that the revenue has fallen by 13% to $55.5 billion. So we've looked at profit and we've said that that's been falling. We've looked at revenue and we've said that's been falling. And you need to remember the relationship between revenue and profit. So revenue minus expenses equals the profit. Revenue on its own is only telling you about the income of the business, whereas when you then minus the expenses, you get the profit. But either way, the top and the bottom line of this company has been falling. So now on to the next big thing that they reported, and this is the one that is really making the headlines. And that's the fact that Rio Tinto have cut their dividends. They cut their dividends by more than 50%, going from $10.40 per share all the way down to $4.92 per share. And this is their first dividend cut since 2016. So it's kind of a big deal for those investors that have been holding on to this stock and really enjoying those high dividend yields that it has been providing. Investors and people in general will freak out about this. They've seen a dividend cut, and typically that means something is going really wrong with the business. Why have they had to cut their dividends? Well, the first thing that I want to say is that Rio Tinto is not alone in this sector. So many other companies within this sector that Rio is in have also had to cut their dividends. And that's because of all these pressures, all these things outside of their control, like we've just spoken about with the iron ore prices and China closing and reopening. That's all impacted these companies. On Tuesday, we heard about the fellow mining stock BHP cutting its dividends, and then just yesterday, Antofagasta also cut its dividends by 60%. And that just means that there must be a common factor affecting all of these companies alike. The next thing that they announced during their earnings call was that they actually cut their capital expenditure forecast. However, they did then go on to actually raise their estimates for 2024-2025. Although there seems to be this word cut being thrown around left, right and centre with Rio Tinto's earnings call, and it seems to be a little bit all doom and gloom, I think there's still something to be said to actually look into this company and see if it has good financials, good fundamentals, good moats, good balance sheets and all of that stuff. So I just had a little look into this myself and I wanted to point out a few things that may be helpful to you guys. The first thing is that they've still got free cash flow of $9 billion. Now they have had an increase in net debt from 1.6 billion in 2021 to 4.2 billion at the back end of last year. But when you see debt increases, you really need to dive into why that's happening. Is it because something is going horribly wrong for the company, or are there other factors in play that actually may make sense to take on more debt? And with Rio Tinto, there are some factors here that actually explain this debt increase. Last year, they completed the acquisition of 2 companies. They acquired Turquoise Hill Resources and Rincon Lithium Projects. And those acquisitions cost them $3.8 billion. So although their net debt is increasing, there seems to be reasons for this. And their free cash flow still is able to cover their debt. So for me, having this company in my dividend portfolio, I am obviously sad to say goodbye to the really high dividend yields, but equally I've said time and time again on this channel that high dividend yields are not everything. They need to be sustainable, and the more important thing is, are they able to increase their dividends over time, and is the company at its core a good business that you want to invest in? And if those things still stand for you in terms of Rio Tinto, then I wouldn't really start panicking about this. Of course, this is not financial advice. Go and look at it yourself and let me know any thoughts that you have in the comments below. Thank you for watching, and I'll see you next time.